and we've just literally managed 2 minutes ago, we managed to place trades there that are going to neutralize our risk on the $87 short call on Yum. So let's just get back into what it is we actually did with Yum. So you can see here, this was the original trade. It was an $87 stroke $70 short strangle trade. So what does that mean? We basically wanted Yum to stay between $70 and $87 after earnings. And it did originally, but now it's pushing onto the $87 area. So I know an awful lot of you listening to this are new to trading, mightn't be comfortable waiting around for something to happen. So we decided as a test case here to just go ahead and start teaching you how to manage this particular trade. So what we did was we'll show you the trades now in a minute, but we added in two new trades to cover this trade off. So the first part was we actually went and bought stock. So the 300 shares that we've got on bought at 86.80, now that will cover our call side, our short call side. So in essence, we have a covered call here. But what we did also here to collect a bit of additional premium was sell the short put. So our bias is now bullish on Yum. So if Yum continues to go on up, we've actually collected in more premium here. So go back to the original trade here. Our max profit per contract was $73. We've now turned that into a potential $201 max profit per contract. So we've actually increased our profit possibility just by selling the $85 same expiry date put on Yum. Now, how we're going to manage that? Let's go into a chart here just for a moment to show you what we're about. So what we're going to do is bring you into the chart of Yum. So here we have Yum has been pushing 87, as we can see. We've covered our position now. But we've also sold a short put here to buy another 300 shares at 85. So that begs the question, you've already got 300 shares, you've got a covered call, but now you've got, you've literally insured somebody else's stock for $85. So what we would do in that scenario is, if the shares of Yum drop below $86, for example, we will actually go and sell the shares at a loss, because the short puts that we own have paid for that fallback in the shares. So that's not costing us anything. What will also happen is the value of our short calls will drop, which will be to our advantage. And now we still have an opportunity to buy the shares cheaper at $85, 300 of them, to cover our short call position. If in the meantime the shares reverse back up towards 87, again we'll go and buy them again just to cover ourselves. So this is how we actually are going to manage this particular trade between now and the expiry Friday on the 15th of May. What we really want to happen now to max profit out of this is for the shares to rally on past 87, keep going up. We'll make our max profit on this particular trade. We'll actually make about $600 out of the trade. We only planned originally to make about $200 to $300. So we will have actually doubled our profit potential if this event does occur. So we'll show you what it looks like in placing these trades. Here we are now. Here's our Yum position. So you can see here we have 300 shares. We're up $33 in those, and here's our short 3 contracts of the $85 put, the May 15th expiry. So we're up slightly on that as well. So now we have these short calls, they're down, but we don't care. That's like a normal covered call. That will all erode over the next 2 to 3 weeks until expiry. These two cancel each other out, and what we want as well is this put to expire totally worthless, and then we're going to make $201 per contract, or about $600 profit per trade. So this is how you manage a trade when one side of a short strangle gets tested. There's still a bit of management left in this. If the shares of Yum start to fall, as I said, towards $86, you may want to go and just sell those shares and just wait for them to rise again before you buy them again, just to cover them. I know it sounds counterintuitive, but you don't want to be on the hook for buying another 300 shares and already own 300 shares. And that's the reason why we would do that. So this is how we will manage this trade on an ongoing basis. This is Stephen from Share Navigator. Thanks and bye for now.